Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, January 20, 2016. Pretty wild day in the market today, and let's get right into the nitty-gritty of it. So here's a daily chart of the SPDR or SPY, and you'll notice that we made a pretty significant low today. We pierced through with some volume the 183.59 level. That was another downside target that I had identified. Now, believe it or not, there's still another one out there, which is down at 177.11. However, a lot of things going on today. So as you can see, this was a recovery today off of the lows, pretty significant one. Let me show you the hourly chart real quick, and you can see what I'm talking about. So we pierced through the 183.59 and made a low and then recovered. And in 3 hours, we recovered from a low of 181 down here all the way up to 187.50. Let me see if I have that right. 187.50 on the button. That's an unbelievable bounce. And that tells me one of two things is going on. Let's go back to the daily chart for a second. So one thing it tells me is that this was a short-term bottom in the market. This is a nice tail on volume. You had 280 million shares today traded. Let me just double check that. Yep, 280 million shares traded today. That's significant volume. And what the likely scenario is, there's really two things that are possible going forward. There's always two things that are possible. So I'm not talking out of both sides of my mouth. I'm just going to give you both scenarios, and we'll see which one begins to play out tomorrow. So the first one is, in fact, I'm going to go to the 10-minute chart for the first one, and you'll see why in a second. Okay, so once it comes up here. Okay, so what the first scenario is that we have a natural pullback tomorrow in the morning to work off some of the very, very short-term intraday overbought condition that occurred this afternoon. And what that would likely do is it would bring the market down in this area here, from here down to here, okay? Down to from basically the 184.50 level down to 183.50. In that zone is where the market would likely want to pull back to in the morning. Number one, it wants to scare everybody into thinking that the move was a fake out, meaning the up move, and it's going back down. That's what the market does under normal conditions. The second scenario is that, and I'm going to go back to the daily chart, the second scenario is that we gap higher in the morning and continue going further to the upside. Now, do I know which one's going to occur? No, I don't. Overnight, lately, over the last few weeks, the overnight sessions in the futures, the E-mini in particular, the S&P E-mini contract, has been wild. There has been 20, 30, 40-point swings in the overnight session almost on a regular basis. So what tonight brings, nobody knows. But if the market begins down tomorrow, you can look for some support in that area of 184.50 to 183.50 in the SPDR. That should provide a good level of support. If the market's going to break down and we take out today's low, all bets are off. And then the likely scenario is we're going to head down to the 177, 177.11 area in that neighborhood. We could stop short at the 200 period moving average, which is at 178.31. So anywhere in that zone. You know, these numbers are calculations, and the market doesn't always stop short of the number, or stop on the number, I should say. Sometimes it pierces through, sometimes it comes up a little short. You use the numbers as a guide and see what the market is doing in and around when it gets to that number. So let me go back to the 10-minute chart. I know I'm bouncing around, but I have good stuff tonight. So as you can see, the market, once it broke down this morning It tried to find some support at the 183.59 only for about 20-25 minutes. Then it broke down and tried to rally back up, back to the 183.59, couldn't get through it, and that's where it broke down. Once we got back above that number, you can see how it tested it a couple of times within the hour and a half that it consolidated above it, but look what happened. How many times do you see me do this? An up move, this is intraday, up move, bullish consolidation, building energy for another up move higher. That's exactly what happened today. And we build energy over the 183.59 level, and you can see how it came back to test it a couple of times, bounced off of it, and then the market was free to move higher, and that's what it did. Now, in the middle of the afternoon today, I'm going to go over to the, oh, by the way, back to the daily chart. Sorry about that, folks. So before I go on to the next market, I want to show you something else. So if the market does move higher tomorrow, the confirmation that we're going to need to see that the market is going to move higher over the next couple of weeks, and there will be a point in which we move higher from a low, won't be a permanent low, it'll be a temporary low, is we need to see a close now above today's high. That's the most important number on the upside, today's high. Today's high in the spider is 187.50. I already knew that number. I don't know why I had to look it up. I just told it to you. So 187.50, the market has to close above 187.50 in order for us to experience more upside in this market. That's at the point in which I'll be able to utilize today's pivot low in order to get the next upside target. And I'm going to take that one off because it's no longer valid. That was from last night, assuming yesterday's was a pivot low, and it wasn't. So if today winds up to be a pivot low, I'll recalculate that. But we can begin taking some of these off. This is no longer valid. This is no longer valid. We'll leave the last two on. And what we have is two scenarios in short. We have to close above today's high in order for the short term, and I stress short term bullish case to be intact, or we pull back tomorrow to the numbers 184.50 to 183.50, and from that point we could catch a rally and still move higher and close above today's high. But the likely scenario, and this is where my money is going to be on, I'm not so sure that we gap higher tomorrow. We could, but my money would be on a retrace. And what I mean by that is basically we had a big up move today, and it's not abnormal at all. In fact, it's completely normal behavior for the market to want to retrace part of this move from this afternoon. And that would bring us back into this area, 183.50 to 184.50, right in this zone. Okay, and if we come back and retrace like this, and the market finds support in this area, that's at the point when we could see another rally ensue. Okay, we'll see what the market has in store tomorrow. But today, you could say that this is a bottoming tail. I would have loved to see it surpass the volume that we saw over here on the 15th, which was 325 million shares. We didn't do that. If we did that, I would feel more comfortable that today was a bottoming tail. It is a bottoming tail, but I would have liked to see it on heavier volume. So the market doesn't always give us what we want, but we take what it gives us and we trade it accordingly. So now, a couple of hours into the afternoon session, 1 or 2 o'clock in the afternoon. In fact, I think it was just short of 2 o'clock in the afternoon. I sent out an email, an update, a market update. And what I was pointing out was that the IWM during the day was significantly stronger than the transports, than the S&P 500, than the Dow, just about everything. And the NASDAQ was also much stronger than those other two indexes. And so what happened was, I wanted everybody to understand that when the Russell 2000 or the IWM leads on the up or the downside first, specifically intraday, and and it was leading by a significant amount. The S&P was down at the time, I think well over 2%, and the IWM was down about 0.6 or 0.7%, maybe 0.6%. That's a significant divergence. So what happened was it was right in this zone here. Okay, so I saw this taking place, and we started to rally in the IWM, and I wanted everybody to understand that the likelihood of a further rally was coming. And short of me coming out and telling you that, that was my way of indicating that there was a divergence in the market on the bullish side. So we know that the IWM tends to lead on the up and the downside, and when I saw that today, I wanted everybody to understand and recognize that trades the market intraday specifically. And in case anybody doesn't realize it, what we're looking at here, and let's go over to the daily chart, is the IWM finished positive today by 0.6%. And the SPY was down over 1%, 1.1%. That's a significant divergence. Okay, now the IWM overall on the longer time frame is still the weaker index, but eventually these markets have to bounce. Now look at the volume on the IWM. 93 million shares, okay, on this bottoming tail, and we finished significantly off the lows to finish positive today. The IWM was down at a low of 95.06. We finished at 99.18. All right, that's a significant bounce off the lows to finish positive on volume. That's the kind of volume I wanted to see on the spider that we didn't get. But this is the volume I'm talking about. 93 million shares finishing positive, well off the lows, made a low, is a bottoming tail. That's the sign of a low. Whether it ends up to be a short-term low in the market, we'll have to see what the next couple of days holds. But this, under normal market conditions, is the type of activity and the type of sign that you're looking for a low. Again, not a long-term low, a short-term low. If it is a low, how long is it going to last? 2 to 3 weeks, something like that, and then the market will turn back down. Now, if it's a low, how high would the IWM take us? Well, there you have it. So I've got 3 lines on the chart. Okay, 104.61, 107.57, and 110.52. These are the levels that I've calculated that if this is a bottom, and we don't know if it is yet, we need to see follow through, and the same thing applies for every market that I discussed on the spider, which is we have to see a close above today's high in order to solidify the fact that the bottom short term would be in. If it is, and I'm only doing this on the IWM because of the type of day it was in terms of volume, the bottoming tail finishing positive, we're not out of the woods yet. This is not set in stone, but I'm reluctant to give you the targets on the spider, but here they are on the IWM. We'll leave them in here for a while and see what happens unless the market turns down significantly and we get below today's low, then I'll have to take them off. But for now, just to give you an idea, and we'll leave them in to see what happens, these are the levels that I've calculated that the IWM could get to on the upside. The 110.52 would be a very, very outside chance. 107.57, not so likely. 104.61 to 105 could happen. Certainly could happen over the next couple of weeks. In fact, I wouldn't rule out the 107.57 either. But the 110.52 is really one of those, lower percentage moves that I'm not necessarily expecting, but it's possible. Okay? So there's the IWM on volume. Very, very interesting day. IWM leading the market in the middle of the day for the turnaround. Now, when I say turnaround, make no mistake about it. It was still a terrible day for the market. The Dow was down 250 and the S&P was down 22, but they were down much, much more than that. So in terms of an intraday reversal, still has the makings of an intraday reversal. We need to see follow through tomorrow. Transports. Same thing with the transports. Look what happened. We got back through my level at 65.60, okay, by a pretty much a significant amount. We hit a low of 64.03 today. 64.03. We got below this by a lot, almost 160 points, and then we rallied back above this line. And that shows you, or at least it shows me, the importance of that calculation, of that price level. These are mathematical calculations. This is just math. And the market does pay attention to math, whether some of you choose or don't choose to believe that or not. Mathematics does play an important role in how the market trades, and therefore this level is telling me that that level was important. Okay, got below it and rallied back above it. However, there is another level below, and that's why I bring up the weekly chart, 57.25. This level would most likely coincide with the much lower level I showed you on the spider. If we close below today's low on the spider, and the transports for that matter, then these next levels come into play. That's just the way it works. Okay, let's move on. Let's go over to the gold market, and we'll go back over to the daily chart, and you'll see that we had another up move, okay, and we got, did we get to 1110? 1109.90. You think 1110 is important? Sure it is. 1109.90. Okay, came up 10 cents short. Okay, we need to close above that level to get to the next level, which is 1125. You'll have some other minor levels of resistance in the middle of that. 1115 is one of them. And but right now the market is inversely correlated with gold. It doesn't always work like that, but for the time being, and I discussed this last night, it is inversely correlated with gold. That being the case, that you're seeing the up move today of about $12.50 in gold, and you saw the down move in the market. 1% up in gold, 1% down in the market. That's pretty much what happened today. So it's not always going to work like that. It doesn't always work like that, but for the time being, what works is working, or what is working works. So we'll have to see what happens. This is a bullish pattern that is potentially beginning to play out to the upside, right? We had an up move to the 1110, a little bit above it. Wedge pattern, bullish wedge pattern, down to 1075. Moving averages, pierced through it. And now we had another up move. Do we see follow through? We need to see a close above today's high. Same thing applies. All markets are the same. All charts are the same. Just the names of the markets change. Nothing else. All markets behave the same way. Why? Because markets are driven by human behavior. Human behavior never changes. So whether you're talking about gold, oil, the stock market, any stock in particular, all markets behave the same, all chart patterns behave the same, because all human behavior repeats over and over and over again. Human behavior never changes because we don't, as a general rule, learn our lessons from our mistakes, in particular when we're talking about the stock market or any market. We're driven by our emotions, and when money is involved, our emotions typically take over, and therefore we continue to make the same mistakes over and over and over again because money is involved, and our emotions typically will dictate what we do as it relates to our money. So that's enough of that soapbox. Let's get off of that, get off of gold, and we'll go on to silver real quick. Now, silver didn't quite have the same up move that gold did, but in terms of percentages, but we did get above the 50-period moving average. We did not close above this high here, which was 14.185. Okay, we did get to 14.17. Now, we got above that high. We hit a high today of 14.22, but we didn't close there. Now, we did close above the 50-period moving average. That's a positive. So silver may be trying to carve out another up move here, but it remains to be seen. There's nothing tradable here in silver. That's the problem. There's no real pattern to trade silver. You had an up move, a down move, an up move, a down move. Now you could make a case that we're inside of a bullish pattern up here, and this is just bullish consolidation. But that's not a pattern I'm willing to trade, okay, because it's really, really sloppy at best. So I'm just pointing out where silver is in terms of, or in relation to the moving averages, the highs that we need to punch through and close above to continue an up move if we're going to get one. But this is not a pattern that has the high probability that I would be willing to trade. So for me, I would just leave it alone, but I'm just discussing it because I know some folks out there like silver, and I just wanted to point out what I saw in terms of chart patterns or lack thereof. But in terms of price, time, patterns, all that stuff. Okay, let's go over to the crude oil market. No surprise, down another 4% today. Just the same routine. There's almost nothing to discuss, similar to there became nothing to discuss after a while in natural gas, and we actually took it off the board. And just for kicks, what's interesting is, look what happened in natural gas. Finally, it carved out a bottom. Finally, it made a bottom, had a nice big rally off the bottom, and now it's failing again, and we're coming back in. But as you can see, and if you look at the longer time frame, and I'll get back to crude oil in a second, this was just a bear market bounce, okay? 3 weeks off the lows, carved out a low, went up for 3 weeks, and now we had a big down week last week, and we'll see what happens, probably putting in another bearish pattern. But let's get back to gold. I'm sorry, oil. That's not oil. Here's oil. So here's, on a weekly chart, here's the third week down off of the bearish pattern that we made. And what am I talking about for the newer folks? Okay, so we come down, okay, we put in a sideways move. And let me do that over again. Let me do it more deliberately. Down move, sideways. Down move, sideways. Down move, okay, 3 weeks in a row. Okay, we're either going to do one of two things. Either this is going to be the week that it puts in a short-term bottom, or we go sideways again and another down move. Where could we go on the downside in crude oil? I know some folks want to know that. We can go all the way down to $22. Certainly we can go to $25. So there's a lot of room on the downside here, and it's not an area you want to pick a low. What you do want to do is you want to look for a sign of a low. You want to look for a high volume reversal day, and then you want to see follow through. You may not be the first one to the party. You may not be able to pick the low. That's okay. Not many people are. But if you can see a high volume reversal day, and then we can look for a pattern that develops that's tradable off that low, you have something to trade against, meaning you know where your risk is. Your risk would be a close below that low that was put in on a high volume reversal day. This is the weekly chart. But all in all, we don't have that, so we're going to leave it alone until we do have that. Real quick, before we get I'll do bonds. I'm going to talk about a couple of stocks real quick after we get done with bonds and the dollar. That's not the chart I wanted. This is the chart I wanted. So look what happened here. Very, very interesting. Well, the market was getting crushed today. Bonds hit the top of our channel. I just find it fascinating how these channels, trend lines, patterns, how this stuff works out over and over and over again. So we had a trend line that was the formation of the top of this channel that bonds were trading in, minus a couple of dips below, and then back in the channel. We hit that high today, which was at 161.18, and right through the top of our channel by a tick or two, and then we backed off of it pretty significantly, right? The high was at 161.18, and we came down over a full point, 1.08 we came down. So a full point plus 8 ticks. That's about $1,250 a contract if you do trade in the bond futures contract. This is the 30-year bond futures contract. $1,250 per contract off the highs today in the bond market. You don't see that every day, although we have seen pretty wide swings. However, if you're paying attention to the top side of this channel, then that was what we were looking at. So I thought that was interesting. Wanted to point that out. We're in the middle of the channel now, or close to the middle of the channel. We'll have to see. Bonds will most... And by the way, this coincided with the rally off the lows that we did see in the stock market. So obviously, there is a current correlation in the bond market to the stock market, just like there is today in gold. So there's a current correlation in bonds to stocks, current correlation in gold to stocks. So money was going into the bond market as it was coming out of the stock market, and vice versa this afternoon. Okay? Let's go over to the dollar, and then I want to talk about a couple of stocks real quick. Nothing to discuss in the dollar, as a matter of fact. Nothing changed from the last several days. The dollar really didn't do much today. Took a little dipsy-do down to the 20-period moving average, but we're still in the middle of no man's land. We're in the middle of the channel, right here in this zone. We're in the middle of the channel, and we're also... let me get the other drawing tool out. We're also in the middle of this bearish formation. So the question is, are we going to see the down move, or are we going to see an up move closing above the high here, going to 105 and beyond? We don't know yet. We'll have to see how the market plays out. This is a long-term bearish pattern that the dollar is putting in. So the longer it goes inside this channel, the longer the likelihood that we break down to the downside. All right, let's go look at a stock. I issued a trade alert this morning, and I understand, let me just get it on the screen. Okay, I understand that when I issue trade alerts, when the stock market is down, the Dow is down 450 points, and, Amazon was down huge at the time. In fact, let's go over to the intraday chart and let's take a look at what happened. So the Amazon was down and going lower. I issued the trade alert at 558.25. Okay. Now the reason that came out, and I'll give you one of the reasons why. Okay. One of the reasons why is because we had a daily gap right here and we pierced through it. Okay. The gap that was filled was right here at 563.91. That was the actual closing price of the gap. Now, we pierced through that and got down to this level at 558. Now, by the time you actually got the trade alert, it was probably down another $4 or $5 from that. Now, I could have waited to see if Amazon pierced through 550. But all in all, that gap level should have produced a bounce. Okay, that's one reason why. There were two other reasons why I issued the trade alert. But the fact of the matter is, and let's go back to the intraday chart to see what happened. Okay, I issued the trade alert at 558. The market came down. And I issued a stop loss order and on a daily chart closing basis. This is a swing trade alert. Okay, so this is a trade alert I expect to play out over days, not hours or minutes. But what happened was, once we came back up and recaptured the 558.25, it was basically doing the same thing the spiders were doing, right? We made an up move. We consolidated above the level, above the moving average, in fact, in this case, for a couple of hours, okay, hour and a half, 2 hours, and then we made that next up move higher. And then at the end of the day, pulled back, and I wouldn't be surprised to see another pullback tomorrow along with the spiders, if that's the move we're going to see. But these are the ones. These are the points in time when you have to step in and buy. If you're in the risk business of buying stocks or selling stocks into strength if you're selling and into weakness if you're buying, these are the areas that you need to step in. Let me just show you one more time. And those of you know I have a gap trading course that's coming out any day now. Just waiting on the technology guy to finish up his work, and then it's coming out. This was a textbook gap on a daily chart level. And when I say daily chart level, that doesn't mean that it's going to stop short at that number at that point in time because it's a daily chart. I do expect it to close above that level on the daily chart, and that's exactly what we got. And look what happened. 558 and we closed at 571. That's a big move. That's a $13 move from my entry price. Those of you that took the trade after the alert, you got a better entry, so you could be up $17, $18 on this trade. We went all the way up to 578.5 today. That's a big move. This is a bottoming tail also, just like we might have gotten on the spiders today. So we'll have to see if that pans out. Nothing's set in stone. We still need to see follow through. But all in all, this was certainly an excellent gap trade opportunity, and we even got it better than the gap level, and the stock finished nicely. So with that, I know it's a long video tonight. We're going to leave it there. Pardon me, leave it there. So I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.